All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing very well, calling you from my alternative studio somewhere in Las Vegas area.
I love it. He is in Las Vegas. I love it. Let's get into it. This is for Friday, January the 12th. Let's talk about last week, the jobs report that came in on Friday. What were your thoughts about it? Let's unpack that for a moment.
Yeah, this is important because last week we recorded on Thursday. We did not yet have the jobs number. Last week, just for color, were three jobs numbers. Two of them came in soft, and then Friday's number came in higher than expected. Basically, the job market is stronger than expected. I forget the numbers. I think they were expecting 160 and they got 210, something like that, 220. Basically, it's another sign that the Fed's not in a rush. And, this week was really about follow through, right? We got CPI on Thursday, and it too came in hotter than expected. I would argue significantly hotter, right? We got 3.1 last month. We expected 3.2. We got 3.4. So not only more than expected, but also reverses a trend. We did get core down sub 4, so it went from 4 to 3.9, but not quite to the expected 3.8. So to kind of tie all this together, the job market is stronger uh, than many thought, and inflation is falling slower than most people thought. So I think what this means for a lot of folks is the market needs to reevaluate when the first rate cut is coming. I believe, I haven't checked the odds this morning, but I believe the odds got as high as almost 80% that we were going to have a March rate cut would be the first. Again, I haven't checked today, but I assume that is significantly less, probably somewhere in the 60s, that we're going to have the first rate cut be in March. So we got to pay attention. We will get another jobs number for January. There is talk that a lot of layoffs were waiting till January. There is talk that the base effect, which is very true, was small this month. It's much bigger next month, that maybe we get a reversal. But yeah, I got to tell you, a 3.4 CPI, a strong jobs market. The weekly unemployment numbers we didn't even talk about came in at 202, below expectations. Not a lot of reason for the Fed to be cutting, in all honesty.
And speaking of cutting, I just want to go back. And again, I'm going off of memory. This was not something we talked in the show notes before a pre-roll, but you had actually thought that in terms of cuts, rate cuts would probably be closer to the summertime, not in
Yeah, I
March.
did.
You called
No,
that.
I did. Yeah, I didn't think a March rate cut never felt right to me. I mean, we would, in order to get a March rate cut, we would have to see jobs breaking, and they're just not. They're just not breaking. So you can argue how bad or how dirty the data is. Um, it's just not. So yeah, I've always thought June would be the first rate cut for sure.
Very interesting. And so again, I know we have a lot of seasoned listeners, people that have been with you, the channel, with us for a long time. They probably have an idea. We're going to come back toward the end. We'll talk about specifically mortgage rates. What we're talking about right now is the federal fund rate. We're talking about Jerome Powell. Let's keep going. Tie this together with consumer spending or anything else with CPI as it relates to consumer spending.
Yeah. So again, if you don't know, the U.S. economy is a consumer-driven economy. You can argue: is it 68? Is it 70? Is it 71%? Let's just call it 70% between friends of the economy is consumer spending. So there was a lot of talk, again, a lot of recessionary talk that the consumer is tapped out, $1 trillion in credit card debt, no savings, yada, yada, yada. And there was a big expectation that consumer spending might disappoint for December. And it didn't. It came out, I think, on Wednesday. It came in not quite as hot as November. November was pretty warm at 0.8% increase. December was up 0.4%, though. Again, higher than expected. At least through the month of December, consumers not tapped out. They're still spending. Again, there's a lot of chatter about buy now, pay later and credit card debt and all of that. But again, back to kind of point number one, the jobs market's pretty strong. Inflation's not falling. Consumers keep spending. No reason for a March rate cut.
Very interesting. I want to just tie in again something off the cuff, not that you would necessarily know this number exact, but
Mm.
a lot of talk about credit card debt, a lot of that spending maybe potentially on credit.
Hmm.
Anything that you would comment there, and just in terms of record high numbers,
Yeah,
credit?
I think there's a couple of things, right? If you want a scary headline, you would be saying things like over $1 trillion in credit card debt. You would be saying things like we've never had credit card balances this high. If your goal is to create negative headlines, congrats, you have it. However, that's not where I live. I live at what is going on with the consumer household. And if you just look at our debt, I don't remember the numbers exactly, but I have reported on it in the past. Something like 92% of our debt is fixed,
Yep.
which is historically high, right? We're usually in the 80s, low 80s. So today, thankfully, most consumers have most of their debt fixed at stupid low rates. So why is that important? Well, if you're operating in a world where you have stupid low payments because you have stupid low rates, you have more marginal income for discretionary. So you can afford having more credit card debt. I don't think it's a great idea. I think credit card debt at 25% is toxic. I know there's a lot of people who live paycheck to paycheck and they're struggling. I get it. But when you look at the totality of the US households, we're generally speaking in a good financial shape. We've never had as much equity. Our net worths have never been higher on a total, median, or average score. So I am not one to live in negative headlines. But I think it's concerning. It's a trend that's probably not good long term, but it's in my world not the scary headline that a lot of people want it to be.
And I like the commentary that it actually brings everything back into balance, because of the fact that most people with housing, fixed rates, people refinanced, people in housing, all the mortgages out there, a big percentage, 85, 90% of them
Mm-hmm.
are, sub what market rates are today,
Yeah.
2, 3, 4% mortgages, 5%
Dude, the
mortgages.
the effective mortgage rate, which is a collection of all mortgages put into one basket, the effective mortgage rate's below 4%.
Yeah.
I mean, it's just that's how the Fed broke housing, because the effective mortgage rate's below 4%. It's crazy.
Pretty wild. Pretty wild.
Pretty wild.
So let's continue then. We talked a little bit about rate cut expectations with the Fed. Anything that you want to comment there? I think we got a little ahead of our notes, but
It's
any
okay.
other thoughts on rate cuts at the Fed level?
Yeah, so I think I read a very interesting article. I want to say her name was Terry. Should have written. I think I do have it here. Let me see if I can find her name. Yeah, Tracy Schuchart, something like that. She actually came out and said she expects zero rate cuts. So the reason I thought we should have this conversation is we now know the extremes.
Yep.
First off, nobody is talking about rate increases. Okay. Point number one. We have zero, which is Tracy, all the way up to 9 with UBS. So now we have the extremes. So the answer is somewhere in the middle. I think the answer is 3 or 4, but that's what we will see over the next 12 months. But I really think Tracy is onto something. I could see an environment, and I don't even have to look that hard, where inflation proves more sticky. We kind of get an asset bump again because of lower rates, where, I Tracy might be right, right? We might get 0. We might get 1. I'm going to stick with my 3 or 4 because I don't like to change with the wind.
Sure.
But I got to tell you that, Tracy's onto something. I think I'll
It's
say it this way.
possible.
I think 0 is a lot more possible than 9.
Got it. Got it.
If that gives you anything about the extremes.
Makes perfect sense. Makes perfect sense. And so too, it also goes something that I feel like was a theme talked about a lot last year, in that we're probably going to see a pretty flat. That's the idea, a flat economy, basically. And maybe a recession, maybe not, maybe the soft landing, like a lot of people have talked about most recently, but ultimately potentially flat, maybe no rate cut. Okay.
Yeah, exactly.
Very good. Very good. I'm going to throw you a curveball here. Something we never talk about. We've talked about very, very infrequently. I haven't even said the word in a long time. Bitcoin, cryptocurrency. I just don't even, I'm even afraid to say it in a social media context. Bitcoin. What are you seeing this week?
So let's talk Bitcoin, not crypto. I want to create that separation because I don't want to get into altcoins and all this other stuff. But I think it warrants a topic, right? Bitcoin has 11 ETFs that got approved or in the process of being approved. We're going to be trading Bitcoin like you could have gold or silver ETFs. I think it does give some legitimacy to the asset. I've been very clear with my audience back in 2018, I put 1% of my net worth in Bitcoin and Ethereum and a couple of other, crappy coins. And for me, it was an insurance policy. But the reason I think the ETF is important is I think there's a lot of people with 7, 8, and nine-figure net worths that will look at cryptocurrency with a side eye, like, I don't get it. Is it crazy? But like me, they're like, all right, I'll throw 1% of my net worth in it just in case it's something. Because again, 1% of my net worth is not good. I won't miss it. But if it hits, all right, let's go. So I think what the ETF brings to Bitcoin is that, family offices, those other kind of big players who aren't going to go get a key or, a fob or whatever it is to store the coins. They'll go to an ETF and go, okay, take 100 grand and, go get me a couple. And then they just won't think about it. They're not going to trade it, right? They're going to call it an insurance policy. And if you're operating in Bitcoin, there's a limited supply. So if you get a bunch of, really rich people buying one or two coins for an insurance policy, you might have something. So I don't know. I thought it was a big deal. Bitcoin ETFs. I think it's a big thing. I think there'll be a lot of people that, throw that insurance policy on, which I did in 2018.
Completely agree. It's not something I think it could be a huge distraction. I know a lot of people that got distracted, real estate guys that got distracted chasing them. I know one guy that actually did incredibly well with it. I think, respectfully, I think with a lot of dumb luck, and he would even say the same thing.
Yeah,
Just
he sold at the right time. Yeah,
and exactly, he did. He bought at the right time out of curiosity, sold at the right time. But again, more something that, hey, like some gold coins in a safe.
Yeah,
it makes sense. That totally makes sense. Okay, very interesting. And I think the legitimacy also, the fact that now they're doing it's being
you got
traded in public
BlackRock and
markets.
Fidelity, and you got all of these, and let's not forget, why is Wall Street doing this? Because they want to make some fees. Let's just be real.
Yeah.
Well, these ETFs exist for fees for Wall Street. They're not doing this for charity work.
Absolutely. Absolutely. So let's move forward then. Obviously, we're right here. It's basically the first third of the new year, new month, January. What data should we be watching? And what do you think's kind of things ahead here in the first quarter or the first month in January?
I think Q1's important, especially if you're a real estate person, because I don't know where this is going. And I don't often say that.
Yep.
I think we have to watch new listing data. I do believe it's too early for us to see a rise in new listings with a 6% mortgage rate.
Yep.
But I do agree we got to watch. I think eventually the move up buyer is going to come back in a big way. I think it's years away. But you know what? Maybe I'm wrong. Maybe there's enough people that have been stuck because they had kids or they're in the wrong school zone or whatever, and they're going to trade their 3% mortgages for 6. Maybe.
Yeah.
I think we watch new listing data. We got to watch new listing data. Second, we got to watch multiple offers. I'm already hearing about multiple offers on first-time home buyer, kind of investor type homes.
Yep.
I'm concerned. We're about a week away, maybe 2 weeks away from most of the country hitting the spring selling season. And if we get back to anything like 5 offers and 10 offers and offer review dates and all of those things, I just want boring, Ty. I want boring, and I'm not sure we're going to get it. So Q1 is something I'm definitely watching.
Wholeheartedly agree. I've seen junk stuff that I just thought was, mediocre, below mediocre, that should have been investor grade. discounted to a fix and flipper, and I've seen that stuff sell,
Mm.
in my opinion, way
Wow.
overpriced. So it's interesting though. One
Wow.
thing I'm noticing in conversations, talking to homeowners,
Mhm.
talking to the regular, you know, somebody that owns a rental, one or two, they feel a little bit pinned up over the last 3 to 5 years because of COVID, because of
Yeah.
the rent regulations, the restrictions, moratoriums. So I think we are going to see some inventory. I just don't think it's
Yeah.
not going to be abundant, but I think we are going to see a little uptick. And that would be my 2 cents based on talking to people. So
Yeah, I think I mean, at the end of the day, housing is very local. I think the only way you figure it out is by talking to people. So I love what you're doing. But yeah, folks, if you're out there, you got a buy box, you got a market, you have clients you're serving, watch Q1, new listings, multiple bid, multiple offers, below, first time home buyer versus luxury. I think there's still very much two markets. But yeah, it's Q1's going to be fun to watch, I think.
absolutely fun to watch. So let me ask you real quick. So we're going to talk about opportunities. What do you think realtors, investors should be doing? Also, I just want to sprinkle in there. What do you think's happening with rates right now, and what do you kind of see going forward over the next several weeks?
I thought it was really interesting. As we opened the show, we talked about strong jobs and we talked about strong CPI, right? 3.4 off of 3.1. That's a big move. I just talked to a couple lenders and rates really didn't move. We got a hot inflation reading and the 10-year was up basically nothing today. We'll get the mortgage data later, but yeah, rates didn't move. I guess that's because the mortgages and rates are looking ahead. They expected a hot number this month. It'll be give it back next month. Um, but as far as rates go, you know, I'm hoping it's 6.25 to 6.5. I think I would be happy with, I got to tell you, I don't want to see sub six. I think sub six is a problem for demand. I think too much demand comes back. But if you stay in the sixes, maybe we get some semblance of balance.
There we go. Stable market, balance, boring, balance, boring. That's what we want. Okay. 6.25, 6.5. I can live with that too. So that's where I started actually. It's funny. When I started in the 90s,
Yeah.
it was 7.5 and went to about 6.5 and was very stable, a very healthy market. So,
Mhm.
um, opportunities, investors, the one rental at a time investor, the one rental at a time realtor, loan professional. What do you think people should be doing right now in January to get business and to get ahead of this?
Yeah. So we'll go loan professional, agent, investor. We'll kind of do it that way.
Yep.
Loan professionals, I think you're going to start to feel a little bit better, right? You guys have seen a significant contraction. I think there's a lot of people who could do the FHA and VA streamlines. So I think we just saw last week refi demand was up 30%. And these are things with no appraisals, no credit checks. I mean, FHA actually protects them to make sure that it's beneficial to go through. So I think there's a general sign that refis will come back, especially if rates just trickle lower. I also think I talked to two lenders today, and they're talking about writing a lot more pre-approval letters. So I know the spring selling season is going to be busy. So I think people need to be prepared. If you're home shopping and not pre-approved, you aren't going to be considered taken seriously. So go find the broker of choice, make that happen. So I think mortgage brokers, you've seen the trough. I'm not calling a great year by any stretch, but I think you've seen the worst of the worst. I think 2023 will be that. So congratulations, build from there. Real estate agents. I am hopeful that we've seen the bottom, right? I do think that 3.8 will be the bottom. I think that's a national number. I think there are some regions that could still be slow. I see mortgage doing better than real estate because they have the refi business. I still don't see transactions going crazy. We might do 4.4 this year, but we're not doing 6 million.
No.
But again, there's a lot of agents that left, so yeah, there's less transactions, but there's less of you, so hopefully you can do that. I would still watch my spend. I think you got at least one more lean year before things maybe unlock. I would definitely still go and try to work out with builders. It's something you and I talked about when I bought my Vegas home, is my agent got paid.
Yep.
So if you haven't created a notebook or a file or something about all the new builds around you, I don't know what you're doing. I think builders figured out that the market moves at 5.5, so they're buying rates down. So if you're not doing that as an agent, I think you're missing something because existing home sales is down, but new home sales I think go up. So get off your butt, go see some builders, do a file, learn the product, sell some homes, and then investors. I think there's a lot of opportunity coming. But we got to be careful. Uh, I still see a lot of pain coming to small multis, 5 to 40 units. I think there's a lot of LP pain coming, but those are the bigger stuff that I don't play in. But I think the same pain's coming to 5 to 40s. I think single families are still where I'm focused for the year. I do hope to add a rental where I live now around here. So I'm going to be learning that. I'll be working with Joe D and some other agents to kind of figure that out. Um, but yeah, it's there's always great deals to be had. Maybe it's buying a fixer, maybe it's buying something long in the tooth, maybe it's, I don't know. But don't rush. Do the work, don't overpay, run your numbers, let's make sure we're doing great deals.
Spot on. I feel like that's been such a mantra. Everybody I talk to, especially new people, really getting the differentiation of a good deal versus a great deal. And the challenge is a good deal could turn into a bad deal if things turn around or your numbers, renovation surprises, things of
Yeah,
that nature. So spot
exactly.
on. Michael, tell people about the event. I know it's sold out. It's been
Mhm.
sold out for weeks and weeks now. I'm excited, man. I feel like we're about a month away now.
Yeah.
You're going to do a virtual. You're literally giving it away.
Hmm.
Are there still seats available? How can people buy the virtual if you still have some seats available?
Yeah, there are a few seats left for the virtual event. It's only $99. The attendees are spending $199 or $499 plus flights plus hotel. They're spending a lot of money. We're giving the virtual away for $99. I've given the agenda so you can plan your viewing, and I'm giving you the recording after because I don't expect everybody to sit there and watch it on their computer screen. So come for who you want, watch the others later, and it will be more expensive. I now have come to the realization I will sell this after and it won't be $99. So if you like to save money, you want to see 23 millionaires ask questions, motivate folks. There is no better place. I've been all over go to all kinds of events. There's no better way to spend $99. President's Day weekend, so you have Monday off. It's pretty wild that we're giving this away for $99.
Yeah. So $99, folks, and you get the recordings. And just so you know, I mean, my thought is the product by as recording standalone, it's worth $200, $199. So if you
Mm-hmm.
have any interest, get the virtual ticket. They're limited. Okay.
Mm-hmm.
We don't know if they're going to sell out or not, but it's very likely it could. We didn't
Mm-hmm.
know if the event was going to sell out. He had to add 25 and then more seats
Yep.
after. So they can go to onerentalatatime.com to buy the
Mm-hmm.
virtual. Is that correct?
Absolutely. Yeah. Go to
I
that. Yep.
love it. Michael, thank you for all the work you do. Have a great weekend, my friend.
You too. Bye.